Okay, thank you all very much for joining the session today. Really pleased to have you along. My name is Tom Hughes. I'm a Senior Underwriting and Claims Executive at the International Underwriting Association, and I'll be chairing the event today. Very pleased that I'm joined by four fantastic speakers that will be taking us through the next hour or so. We have Natasha Oates, Contract Wordings Manager at Lancashire Group. Natasha, can you give us a wave? Thanks very much. We have Rachel Evans, Regional Head of Product Development Financial Lines at Allianz Commercial. Michael Allan, Head of Wordings at Convex Insurance. And finally, Christopher Crane, Legal Director at Wikborg Rein. Thank you very much. Now, just before we get into it, it's worth noting that we will be focusing on English law and using the lens of English law throughout the session today. So just bear that in mind as we move through the various topics. Now, this is, of course, part of our 2024 series of Policy Wordings Masterclass sessions. We have 4 in place. We've already completed part 1, Mastering Risks and the Scope of Cover. And here we're focusing on session 2, Unravelling Claims, Loss and Resolution. Now, these sessions have been set up by the IUA's Clauses Committee, and it's brilliant that we have a range of speakers from that group that have been helping us through the various sessions. So the agenda for this session 2, our speakers are going to be taking us through a number of very important areas, and you can see them on screen there. So we have the insured parties, claims conditions, aggregation, causation, loss and dispute resolution. We'll start off with some technical presentations and build in the opportunity for some practical application, so to actually put the learning into effect. And what we won't have during this session is Q&A and discussion, which we had at the live event. Now, in case you were wondering, who is the IUA? Well, we have 81 member companies, and there'll be lots of familiar names on the screen in front of you. And essentially, these companies are insurers and reinsurers who are active in the company market in London. They are the companies that we represent and that make up our various IUA committees across all classes of business. Now, one of the roles we as IUA have is to publish model clauses and wordings. And the key question to consider is, well, why do we do that? And there are a number of different reasons, but the primary reason is member demand. And that could be in respect of emerging risks, recognizing legislative change, perceived inadequacy in existing clauses, or to provide alternative coverage options. Now, it's worth noting that individual insurers and brokers will continue developing their own provisions, as they always have done. But our forum, the Clauses Committee, brings together technical wordings experts to draft model clauses. Now, they are only models or templates, and they can be used as drafted, they can be amended or used in part, or they can be completely ignored. Now, the committee itself at IUA, it's the only group that can publish a clause or a wording with an IUA code on, and that's across all classes of business. We have some broking reps on the group. We currently have 6 broking firms represented, and we have 1 legal expert, Christopher Crane. Now, the types of clauses and wordings that we publish, you can see some of the examples that we have there across the last 2 years or so. And you'll notice that they're very wide-ranging and certainly touching a number of different classes of business. Now, where can the clauses be found? Well, they are freely accessible and searchable, so you can find those on the IUA clauses website. There will be essentially a library of all of the IUA clauses that have been published, and also including some of the joint marine and aviation clauses that are published by both IUA and LMA. You'll note that we do also issue commentary or guidance with the clauses, and we work on that with the Clauses Committee and with those broking representatives who give us fantastic input during the drafting process. Okay, and with that introduction out the way, I'm pleased to be able to hand over to Chris Crane for section 1, the insured parties.
Thanks, Tom. So, to get started, one of the first questions to ask when there's a claim will be, is the party that has suffered the loss insured under the policy? Commercial policies usually provide cover for multiple parties under the same policy, so it's essential for those parties to be accurately identified and recorded to avoid potential problems later on about whether a party claiming for a loss is insured. So we thought it might be helpful to show some examples of terms that are commonly used in the description of the insured to extend cover to different parties in a fictional group structure. In our example, the Swan Pubs Holdco and the Swan Restaurants Holdco are separate but commonly owned parent companies of a chain of pubs and restaurants. The Pubs Holdco has 2 subsidiary pubs, and the Restaurants Holdco has 2 subsidiary restaurants. There's a separate services company that provides management services to the group, and there's a separate development company that develops new sites for the chain, such as the New Swan Limited, which in this example is acquired halfway through the policy year. The development company engages independent contractors and subcontractors, suppliers for its development projects. Obviously, this is an entirely artificial structure and scenario, but really the aim is to look at how various terms can be used to define parties under a policy. So, excuse me, looking at the identity and description of the insured, the position is straightforward if there's a single named insured. Here, only the Swan Inn Putney is insured. No other entity in the group would be able to claim under the policy. Of course, more than one party can be a named insured. So now both the pub and the restaurant hold companies have become named insureds, but again, none of the other entities would have cover. In many cases, it will not be practical to identify individually every insured party, so parties are often identified as part of a defined category. For example, adding "and any subsidiary" would extend cover to direct subsidiaries of the named insureds, but that might not be sufficient to cover the whole range of corporate structures that might exist within the group. So you'll often see language such as affiliated, associated companies. This kind of wording may also include interrelated, managed, joint venture companies and partnerships. Clearly, when broad categories such as these are used, both the underwriters and insureds need to make sure that there is agreement about who is intended to be covered. In our example, affiliated and associated companies would likely extend cover to the services company, but depending on the circumstances, the development company might fall outside. So if the intent is for the development company to be covered, then it might be safer to individually and specifically identify it as a named insured. Large organizations may also wish to ensure that there's seamless cover for new entities that may be acquired during the policy period. In our example, a new pub is acquired midway through the year. So the language "now existing" or "as may hereafter be constituted or acquired" allows new entities that come within the defined categories to be automatically added to cover. Of course, that could change the risk profile, so insurers should consider including a requirement that any additions be notified and endorsed to the policy. In addition to the corporate entities themselves, cover, and particularly liability cover, may be needed for the individual directors, officers, employees, and representatives in their respective capacities for those entities. And finally, in our slightly unusual example, but very common in construction policies, cover can be taken out on behalf of certain third parties, including, for example, contractors, subcontractors, and suppliers, in connection with their interest in a development project. Depending on the insured risk, different policies may need to provide cover for a range of different parties and interests. But the key point that we wanted to emphasize here is that at placement, it's essential to check that the named insured is accurately identified and that any categories of additional insureds are properly defined and agreed. On that note, I will hand over to Rachel, who's going to talk through claims conditions and aggregation provisions. Over to you, Rachel.
Thank you, Chris. So as Chris said, in this section, we're going to look at some key claims conditions, how the policy responds when there is a claim. We're notably looking at notification and aggregation. So conditions come after the insuring clauses and exclusions in the policy generally, and they set out what the insured must or must not do. They also sometimes contain conditions on what the insurers must do as well. They often look innocuous, but they contain some very important details about the operation of the policy. So they should always be approached with some caution, and there's really no substitute for reading them, because consequences for not complying with them can have substantial impact on coverage. Well, notification clauses differ depending on what type of insurance you might be writing, and therefore when a matter or an event or claim is capable of being notified. And you may remember from the first session that the differences between losses occurring and claims made policies were discussed. Just a quick recap here. In losses occurring, we're covering losses arising out of accident or events occurring during the policy period, whereas on claims made, the cover trigger is claims that are first made during the policy period. And it's generally easier under a losses occurring policy to ascertain whether the loss has occurred. So for example, on a property policy, if there has been fire damage at the property, it's often obvious that that has happened, and it can be notified to insurers. And the timing of that notification is perhaps not so important. What is critical is that you make the notification to the insurers who are on risk when the loss occurred. With claims made policies, as we are going to see through the next few slides, notification might be a little bit trickier. So if you're expected to notify claims, the first thing you need to know is there a claim? Well, the first thing is that a claim must be communicated. And the case of Robert Irving stated that there needed to be a communication by the client to the insured of some discontent for which they expect a remedy. And the translation of that into policy language often looks a little bit like this: a written demand for of an assertion of a right to civil compensation or damages by a third party against the insured. In policy wordings, it's often limited to written demands rather than just oral demands. So once you've established there is a claim, the wording will probably also contain an obligation to notify those claims within certain periods. Notification as soon as reasonably practicable following the claim is a standard formulation. Sometimes this is tempered by the awareness of that claim and then the insertion of different top bods at the insured entity. However, there are other formulations for timing obligations. Immediately is one of them. That is obviously quite a high bar, or within a set amount of days is another. Again, that's quite a difficult bar to comply with. If you are writing contractors, design, cover, notification of adjudication is usually required within 2 working days, because the adjudication process is so condensed. It's important that insurers are on notice as soon as possible. So as soon as reasonably practicable is fairly standard, but what does it mean? Well, the central case on that, and indeed on notification, is the case of Kidson's, where it was held that notice given a month or so after matters were identified was held to be as soon as reasonably practicable. but notice given 4 months after the claim was not held to be as soon as reasonably practicable. The usual health warning comes with any legal judgment. All cases are fact specific. So I'm not standing here telling you that notification on an as soon as reasonably practicable wording is somewhere between 1 and 4 months. All that this case is showing is that there is some latitude as to what as soon as reasonably practicable means on the facts. Another important point to note about claims made policies is that it's not just for claims notified during the policy period. They also cover claims made after the policy period, but which arise from circumstances first notified during the policy period. And that's because of this, the policy's deeming provision. You'll see here that it sets out any circumstances notified, that later a claim arises out of them, then insurers shall deem the claim to have been made at the time the circumstances were first notified. And as I continue on, you will note that notification of circumstances by an insured must be clear if the insured later wants to rely on the deeming provision for the later claims. So what is a circumstance? Well, unlike with claims, policy wordings do not generally define what it is, but case law does give us a bit of guidance here. It's an objective test. It's what a reasonable insured would consider, whether they would consider a circumstance would develop into a claim. There has to be an element of an external fact, not just mere concerns of the insured, and a real, not an imaginary prospect that a claim could emerge. And that's quite a high bar for an insured to comply with against the backdrop of the issues that might be bubbling away at the insured practice. There are also different bars for notification of circumstances to be found in policy wordings. Some require notification of circumstances where they are likely to give rise to a claim, others where they may give rise to a claim. In the case of Laher, it was held that likely meant that there was more than a 50% chance of a claim materialising. On the other hand, in the same case, though, may was held to be just over 20% of a claim materialising. And it's important for policyholders to understand the difference between these nuances of notification requirements, but also for underwriters to understand how this might impact the coverage that you're giving. Turning to the form of notification, it's often not prescribed in policy wordings, but if it is, the insured should follow it or risk breaching the condition. And here is an example from a policy. The notification must be in writing. You have to give the reasons, full available particulars, the nature, dates, persons, parties, and when the first awareness of the circumstance arose, and the affected insureds and claimants. So why does all of this matter? Well, speakers at the last session may have touched on this, but in short, if you fail to accede to the notification policy language, it could mean that the claim is not covered and insurers have the right to deny the claim. That will depend on whether the policy wording frames the condition as a condition precedent or a bare condition. And this pictorial representation hopefully illustrates the differing effects of those conditions. So with condition precedents, the underwriters can avoid the claim if the insured has breached. But with a bare condition, the insurer is not entitled to avoid liability for the claim. Instead, they're entitled to damages for any prejudice suffered as a result of the late notification. As I said previously, notification of circumstances needs to be clear if the insured will be entitled to rely on it later down the line. So going back to the Kidson's case, it was held that the notification there was invalid and insurers could deny the claim. There were some internal concerns about tax products that the insured accountancy firm had been marketing. However, the board didn't consider the concerns justified, but nevertheless, they did communicate with insurers about the position. But they said this might be material information to insurers, which didn't really explain too much. And then after further investigation into the products was made, they sent a later communication to insurers saying that the technical efficiency of the products was actually accepted, but in some cases there might be procedural difficulties. Well, when the claims did eventually arise, the court said it would depend on what the reasonable recipient would have understood from reading the attempted notification. And the Court of Appeal held that the notification language had not been complied with. The insured had failed to identify any act, error or omission. They had failed to identify any potential claimants who may have suffered loss. And the insured had failed to say that they were actually notifying a circumstance. So the insurer would reasonably not understand that a notification had been made, and therefore they held the notification to be invalid. So let's just look at some key points for notification clauses. They are a trap for the unwary, and they are a frequent source of disputes between insurers and insureds. So top things to be aware of: use clear and unambiguous language. That goes without saying, not just for conditions, but policy language in general. And understand the effects that different wording formulations can have. Are you giving? Are you expecting notification when it may give rise, when circumstances may give rise to a claim, or when they are likely to give rise to a claim? Are you framing the condition as a condition precedent, or not? It really does remain a pitfall for insureds and a source of many coverage disputes. So please do read your policy language here. Now, turning to aggregation, just a whistle-stop tour, because the issues are quite tricky to unravel, and we could have an entire wording session just devoted to this. First question is, what is aggregation? Well, here is my visual mnemonic for aggregation. And quite simply, aggregation allows two or more claims to be treated as one loss, where they are linked by a unifying factor. This can be beneficial for either the insured or the insurers, depending on the specifics. For example, if there are some large losses, aggregating them into one claim can assist with keeping the insurer's exposure within the policy limits. However, if there are a large volume of smaller related claims, aggregating those can be beneficial for the policyholder because they only have to apply one policy excess. The question of whether and how claims aggregate turns on the policy wording and how it describes the unifying factor and how that is applied to the facts of the claims. So let's look at some different formulations for the unifying factor. Well, the first type is event or occurrence language. And here, as you can see in the red, we are aggregating claims where they are consequent on or attributable to one event. So clearly this language requires a definite event to occur, and therefore aggregation wording on this formulation is interpreted narrowly. And an example of this is the claims by the airlines following the 9/11 disaster. The aggregation language in those policies was an event-based wording. Was the bringing down of the Twin Towers one event or two? Did they aggregate? Well, despite there being some degree of unity as to time, place, cause, intention, on a strict interpretation of the language, it was regarded by the English court that they were two separate hijacking acts carried out on two separate aircrafts, and therefore the claims did not aggregate. Turning to a cause or original cause aggregation formulation, here we're aggregating claims that are consequent on or attributable to one source or original cause. And this formulation is generally regarded as wider in its application, and it potentially allows for the aggregation of claims on the basis of an ongoing state of affairs or an original cause that's far removed from the immediate proximate causal act for the claim. For example, damage caused by aftershocks of an earthquake would aggregate with the claims arising from the damage caused by the initial earthquake under this cause or original cause language. So let's look at a legal case on this language, remembering that claims are aggregating where they are consequent on or attributable to one source or original cause. So there were 750 former patients making medical negligence claims against a single doctor at a private hospital. All of the underlying claims arose because the doctor had performed some surgical procedures, on the one hand, incorrectly or incompletely, and on the other hand, entirely unnecessarily. Insurers argued that all of the patient claims were attributable to one source or one cause, which was the doctor's conduct, whereas the hospital argued that the claims should aggregate into two groups, those that were incomplete or unnecessary operations, sorry, incomplete or incorrect operations, and those which were unnecessary operations. Well, the Court of Appeal held that the patient claims aggregated into one claim. They stated that as a matter of ordinary language and applying the principles applicable to aggregation clauses expressed in these wide terms, the doctor's conduct and disregard for his patients was the unifying factor, irrespective of which patient group he was dealing with. And that was the Spire versus RSA case. So just moving on from the event language, here we have a series clause formulation. It broadens the event or act language from a single event or act to a series of events or acts. And this is the aggregation language used in the SRA minimum terms and conditions. And one of the leading cases on aggregation under this formulation is the case of AIG and Woodman. It was a professional negligence claim against a firm of solicitors by 214 investors. Those investors had either invested in property developments in Turkey or Morocco. The insured solicitors were not supposed to release the investors' money to purchase the development land until adequate security was in place, but unfortunately they erred in that duty. Both of the developments failed, and the investors lost a total of £10 million and sued the solicitors. So on this aggregation language, did the claims aggregate? Well, was there one claim because all the claims aggregated? Were there two claims because there were separate developments in Turkey and Morocco? Or were there 214 claims because the claims did not aggregate at all? Well, there was a lot of disagreement about how to apply this language in the lower courts, but on appeal and up to the Supreme Court, they decided that the word related simply meant that there needed to be a real connection between the transactions, or in other words, they must fit together in some way. So on the facts, the Supreme Court held that there were, in fact, two claims. The claims relating to the development in Morocco aggregated, and the claims related to the Turkish development aggregated. So we're just going to have a little look and have a think what you think about aggregating language. So aggregation under a series clause. The solicitor was regularly diverting sums of money from her firm's client's account to pay her personal and family expenses. She diverted funds following the sale of client assets directly to her own account as well, sometimes entirely bypassing the client's account. In total, over £4 million was appropriated from 85 clients. Mainly, this conduct took place between 2010 and 2015, but the first misappropriations began back in 2002. It's again the solicitor's minimum terms, so we're on the series of related acts or omission language. Insurers obviously argued that the claims aggregated because there were a series of acts and omissions that were related over an extended period of dishonest conduct. The insured firm argued that they did not aggregate. They were unconnected misappropriations, and the fact that they'd been carried out by one person was not sufficient to deem them related. So we're not doing Slido here, but what do you think? Do you think the claims aggregate? or not? Well, it was held that the claims did not aggregate, and that was the case of Baines and Dixon Coles. And the decision came as a surprise to many. And that's why I keep giving the health warning that judgments are always fact specific. And this marked a move away from the AIG and Woodman case that we just looked at. The Court of Appeal considered the Woodman case and the requirement for the real connection and the claims fitted together in some way, but they dismissed that requirement in this case. They said that what is required for aggregation under the series clause is that claim A is caused by a set of facts, A, B, C, and claim B is caused by the same set of facts, A, B, C. So the Court of Appeal held on the present case that each misappropriation had a separate set of facts and had nothing to do with the thefts from the other clients. They were all separate events. Notably, the Court of Appeal also said that if insurers were permitted to aggregate all claims arising from repeated similar negligent acts or omissions, but in different settings, the scope of aggregation would be almost limitless. And so this was quite a surprising decision, but there does appear to be some resistance to aggregating solicitors' dishonesty claims because the policy there is to protect the public and not the solicitor. And that approach of not aggregating dishonesty claims where solicitors were involved was approved and confirmed in the 2024 case of Axis and Discovery, where it was also held that a series of claims did not aggregate. So I'm just going to finish on a summary points for aggregation clauses. Well, aggregation is a two-way street. It's not possible for me to give you advice on what's the best type of aggregation wording because insurers' interests are not fixed in one direction. However, it is important that you as underwriters understand the difference between what the language achieves. Are you writing policies with the widest originating cause language, which demands only a loose causal connection? Or are you writing on more restricted event act language? And then finally, although legal judgments are very fact specific, do consider how recent case law might impact the business that you are writing. And now I'm going to hand over to Chris, who's going to talk on causation. Thank you.
Thanks, Rachel. So, a claim has been notified, but for it to be valid, the insured must prove that its loss was caused by a peril insured under the policy. In the context of policy wordings, the causal language used in insuring clauses and exclusions can have a significant impact on the scope of cover granted under the policy and whether the policy will respond in particular circumstances. A good example of how this works was the recent case of Brian Leighton Garages, in which a petrol station was forced to close for safety reasons after a leak from the fuel line contaminated the land. Although the policy contained an exclusion for damage caused by contamination, the court found that the exclusion only applied if the contamination was the proximate cause of the damage. They decided it was not, but rather the proximate cause of the damage was the rupturing of the fuel line by a sharp object. The subsequent fuel leak was merely the inevitable consequence of that cause. The underwriters may well have thought that they had excluded contamination damage, but on these facts and the language of the wording, the exclusion did not apply and there was cover for the damage. At the heart of the Brian Leighton case is the concept of proximate cause. Unless the policy clearly states otherwise, the courts will generally assess whether the loss was proximately caused by an insured peril. This involves a common sense factual inquiry on a case-by-case basis. The proximate cause is the primary reason that an event has occurred and the cause that has the most significant impact in bringing about the loss. Importantly, the proximate cause need not be the cause immediately before the loss occurs, but rather It is the dominant or efficient cause of the loss. For example, in an earthquake, it may cause a water pipe to burst, which in turn leads to water damage and loss, but the earthquake would still be the proximate cause of the loss. Similarly, if damage is caused by water used to extinguish a fire, then the proximate cause of the loss would be the fire. The concept of proximate cause is based on the presumed intention of the parties as to when the policy should respond, and the courts will generally not, therefore, draw fine distinctions between various common phrases used in policies to express causation. So each of the phrases in the box on the slide, caused by, directly caused by, occasioned by, due to, resulting from, arising out of, are generally understood as having more or less the same meaning. And where this language is used, the courts will look for the proximate cause. That said, it is open to the parties to agree on a stronger or weaker causal connection, but clear language is needed to do this. On the slide, we've put a sliding scale of commonly used causation language. Solely and directly caused by requires a strong causal connection between the peril and the loss. So if it's used in the insuring clause, it will narrow the scope of cover. It will also narrow the scope of an exclusion, but of course, a narrower exclusion means more overall coverage. On the other side of the scale, indirectly indicates a looser causal requirement than proximate cause, but even an indirect cause must be a contributing factor. So in many cases, the difference may not be all that significant. In connection with is generally understood to express only a relatively weak causal connection, and following needs more than just a temporal relationship and is clearly a weaker causal connection than proximate cause. Going back to the Brian Layton case, if the wording of the exclusion had been in connection with or following rather than caused by, the outcome would almost certainly have been different. In the first session of this series, we explained that where there are two approximately equal proximate causes, the policy will respond where one proximate cause is covered and the other is neither covered nor excluded. But the policy will not respond where one proximate cause is an insured peril and the other is expressly excluded. There are a couple of points to note on this. First, this is the established position under English law, but it may not be the same under the laws of other countries. So this may be something to consider when selecting choice of law, which Michael will discuss in a moment. Second, if the insured can prove that the insured peril caused a distinct part of the loss, it will be able to recover for that part, although it will not be able to recover for any part of the loss caused by the excluded peril. The anti-concurrent causation clause at the bottom of the slide is designed to explicitly and completely exclude cover in circumstances where there is any combination of covered and excluded perils. The key takeaways are therefore that unless there is clear language in the policy, the courts will assess whether the loss is proximately caused by an insured peril, but the parties can modify and calibrate the causal language in the insuring clause and exclusions to match the intended scope of the insured risk. Now, over to Natasha, who will take a look at provisions relating to the settlement of claims.
Thanks, Chris. So we've looked at who's insured by the policy and how they notify claims, and that the claim is caused by something that's covered. So we're now going to look at what they might receive as a claims payment. So the starting point for determining what an insurer will pay is indemnity. You might see a statement like the one at the top of this slide in your insuring clause. So this policy will indemnify the insured for. Now, indemnity is one of those very insurance-y words that you don't hear anywhere outside of the insurance industry, and so it's one that might not be accessible for a consumer or a non-sophisticated customer. So in consumer policies, you might see things that say cover or pay, but indemnity has an actual meaning, and that meaning is that the insured will be put back into the position they were before the loss. Now, this isn't perfect. Insurance policies will only ever be able to compensate someone for their monetary loss. So if someone's lost a family heirloom or watched their house be destroyed in a fire, there won't be anything that the insurance can do to compensate them for emotional damage. All we can do as an industry is replace the items. So we're going to look in more detail about what putting the insured back into the position they were before the loss means. What the actual settlement basis is will be dependent on the class of business. So we're going to look at a few different lines, and we're going to start by considering property. So for property, what an indemnity would look like is the value of the property that's been destroyed with deductions for wear and tear and depreciation. So if you have a 10-year-old machine, you'll be given the value of a 10-year-old machine as an insurance settlement. The general principle that this reflects is that the insured can't recover more of the value of their loss. There shouldn't be, and another very insurancy word, betterment. They shouldn't be put into a better position than they were before the loss. However, this basic position can be varied in the policy wording. So let's have a look at how this can be varied in some cases. So for property, you might be looking for a basis of settlement clause. And in that, the policy will set out if there are variations from the indemnity principle. Now, the first and most general way to look at that is on the basis of reinstatement or new for old. And where covers on this sort of basis, you'll see language like equivalent to or substantially the same as, but not better or more extensive than its condition when new. Or you might see something like without a deduction for depreciation or wear and tear. And that's what sets it apart from indemnity. So if you have a 10-year-old machine under this settlement basis, you'll get replaced with a new machine. There also might be cover under specific headings for specific types of property. So for example, you might have a clause that deals specifically with pairs and sets. In a pairs and sets clause, you'll often get some money towards a loss of match. So for example, if the insured has a 3-piece suite, if one chair is damaged, the insurer won't usually pay for the undamaged part, but they might pay some money towards the loss of match that getting a new chair is going to cause because it's from a different, the one that they didn't have had before is no longer available. And another example where you might get kind of specific settlement types is electronic data, where the value of the data itself will often be excluded, but the insurer will usually say that they will pay money to reconstitute that data with a specific method, such as restoration from backups. And then finally, I want to talk about on this slide, there's another settlement type that might be seen, which is agreed value. And you see this under classic motor cars or for jewellery. And this is where the amount of money that the insurer will pay in the event of a loss is set out at the outset of cover. And this won't be adjusted for the real value or for market prices or fluctuations. You will just get the set price that's been agreed. The next thing I want to consider is what happens if the insured hasn't insured the full value of the property under an indemnity policy. If that's the case, then the insurer might want to apply average, which is a proportional reduction of the claim payment based on the value that the insured told the insurer it needed. So it's important to remember that in order to use average, it needs to ensure that there is an average clause in the policy. Otherwise, the only restriction will be the policy limit. So normally a clause for average will include setting out the sort of calculation that's on the slide that will show the proportional payment, how the proportional payment will be derived. As we can see here, the insured has covered the cost of their mansion for the cost of a dilapidated shack. So the loss is then paid out as a calculation of proportion of that. And so the claim payment is reduced from 9 down to 3. Of what? make up your own minds. This type of average is not to be confused with the marine principle of general average, which is a type of loss that can be paid by insurers in marine claims. Sorry, we're not going to go into that in detail, but just wanted to mention that it's not the same thing. Turning now to how liability policies might indemnify a loss. So loss under a liability policy is different to property. You're not seeking to replace a piece of property of the insured, but instead protect their legal liabilities. And so the indemnity will be for their legal liability. And this can have several different components. So one component will be the amounts that they have had awarded by a court or that they've agreed as a settlement to pay to a third party. Another component will be the costs the claimants have incurred, which are awarded by the insurer. Awarded against the insured by a court. One component, so a liability policy will also usually cover the cost to defend the insured. So in the UK, insurers will usually have qualified right to defend the insured. The defence and defence costs will be in the hands of the insurer, and the insurer will control the defence and cover the costs as long as it believes that it's reasonable to defend and that it's economic, and rather than to settle the action. It's important to consider what the jurisdiction is, though, because other jurisdictions will differ on how defence costs are covered. And then finally, another important point to consider on defence costs are whether they are included within the limit or whether they will erode the limit of erode the limit of insurance, or whether they'll be in addition to the limit. This will depend on the usual practice for the line of business, the litigation risk, and sometimes the cost of the policy. If you've gone for a cheaper policy, it might erode the limit. Inside the limit can be better for insurers because you then know what the absolute maximum that is going to be payable by that policy. But having defence costs outside the limit will usually mean that it's uncapped and won't erode the limit that's available for settlements. So, and then other types of policy will have other settlements. So life and personal accident policies, for example, won't work on an indemnity basis. You can't compensate someone for losing their own life or the life of a loved one, depending on who the payee is. These instead are fixed amounts or percentages that depend on the severity of an injury. So, for example, the death of the person might have a fixed amount of 100,000, and then the loss of a little finger might be 1% of that amount. And then I've got listed here some other payments that you might see for other types of policies, which are based on the indemnity principle of putting the insured back in the position they were before a loss, but are slightly more unusual things to pay for. For example, you might have crisis response costs and credit monitoring costs following a cyber loss. You might pay for public relation consultant costs under a product recall policy, for example. Professional costs like lawyers and accountants can be paid to help quantify losses for business interruption. You might have ransom payments under a piracy policy, or under some of the newest policies that you get in the market, you might get compensation for carbon credits when carbon credit schemes fail. So we've considered the different types of loss, and then one important thing to consider is when thinking about what an insurance policy might pay is the limits and how these work. So it's important to consider if the policy has an aggregate limit overall, which erodes and reduces with each claim, or whether the claim is per occurrence or per claim, in which case the principles that Rachel was talking about earlier will come into play as to how those claims are grouped together. And something else that might be included in the policy is anti-stacking language. This is language which stops limits and sublimits stacking on top of each other to produce a higher and usually unintended absolute limit for the policy. For instance, a per occurrence limit of £1 million with a sublimit for electronic data of 500,000 should be clear whether that sublimit is in addition to or part of the main limit of insurance. And that could be the difference between the policy having an absolute limit of £1 million or having a limit of £1.5 million. Another point to consider is where the insurer sits in an excess position in a policy tower, whether there is an intention for them to drop down over aggregate limits when those aggregate limits are eroded, or whether they intend to sit excess of the policy limit. And that will come down to the individual policy, but there should be clear language to reflect that when you're sitting in an excess position. So we know what the insured is being paid for. We know how that might be limited, but what happens if there's a delay in paying that claim? The insured might seek damages for late payment. The right to damages for late payment of a claim is a statutory one, which is set out in the Insurance Act as modified by the Enterprise Act. This sets out that there's an implied term that the payments are made within a reasonable time frame. What is reasonable will depend from claim to claim. For example, in the recent case of Quandra and Excel, the judge held that it was reasonable that the insurers hadn't paid a claim at the time of the trial, as it was a complex fraud where it had been reasonable to investigate the claim and that the investigation had happened within a reasonable time frame. Because this is statutory right, there's no need to include language in the policy to grant this right. There's only a need to include language if you want to contract out. And as with other terms under the Insurance Act, if you want to contract out, you need to make sure you're providing clear notice in the policy document. But what happens if the insured has presented a fraudulent claim, either a fully false claim or inflating the value of the claim? Well, in that case, the insurer can rely on the Insurance Act, which permits an insurer to terminate the policy from the time of fraudulent act. The insurer also doesn't need to return any unearned premium. They won't be liable to pay the claim, and they can recover amounts that they've already been paid in respect of that claim. Any claims made before the fraudulent act will remain valid, and the insurer won't be able to claw back amounts in respect of those claims. Again, because this is a statutory position, the insurer doesn't need to include a clause about fraudulent claims in the policy. However, there is often a fraudulent claims clause that should set out the statutory position. There's also this is also a provision that can be contracted out of and would again require clear notice. You also might find some cases where the fraudulent position is disapplied. For example, in directors and officers, you might find that the insurer may agree not to hold a fraudulent act of one director against the others and will leave the policy valid and in place, but cancel it in respect of that director. And what happens if the insured has more than one policy covering the same risk and they have double insurance? Well, this is one place where the principle of betterment comes in again. We talked briefly about that before. The insured can't recover more than they've lost. They can't be put back into a better position than they were before the loss. And so the amount that they can recover from the policies will usually be reduced so that each policy makes a contribution to the loss in equal share. This is the general principle, but this can be varied by contractual language, usually in other insurance or non-contribution clauses. You'll see on the slide two different types of clause. The one in red I'm going to call an escape clause, and then the one in blue is a rateable proportion clause. So the escape clause says that if there's another policy covering the same loss, this policy won't pay. The rateable proportions clause says that where there's another policy, it will pay in proportion that its limits are to all of the limits covering the insured. Now, if both policies have these sort of clauses, there is some guidance from the courts on how these might be interpreted to work together. For example, if both policies have an escape clause, then they cancel each other out, because it wouldn't really be fair for the insured to be left with no cover at all when they've paid for two policies. If one policy has an escape clause and one has a rateable proportion clause, then the rateable proportion clause will have to pay a loan. The escape clause will win out because they wouldn't have paid from the first pound. You can also see clauses that will say they will respond in excess. I don't think these have been considered by the courts, but I can see that they could be considered in the same way as the escape clause, because they say that they won't pay from the first pound. It's also worth bearing in mind that some policies will say that they respond first if there is a more specific insurance that they will cover. For example, I've seen this in relation to terrorism policies where they are a specific terrorism policy and there's a wider property programme. So it will say in respect of a terrorism loss, this policy will pay first, and then the policy properties will sit in excess for any claims where there might be an overlap. So the insurer has paid out the claim and is looking to see if it can recover any of the loss that's paid out. So this is where subrogation comes in. If there's another party that might have contributed to the loss or is to ultimately blamed, then the insurer has an implied right to recover against these parties. And this is also known as subrogation. The insurer will sue in its own name for the losses it's paid on behalf of the insured. There can only be one action, so it also might be recovering uninsured losses that the insured has paid, such as an excess. This is an implied right in a policy of indemnity, so there's no need to include a clause unless the insurer wants to vary the implied condition. However, there might be a condition on the policy that the insured shouldn't do anything that might prejudice the insurer's rights, and that it should cooperate with the insurer in seeking a recovery. And you might see language such as the one in this slide to do that. It's also an implied right that the insurers can't subrogate from co-insured, but it can be overridden by express language to the contrary in the policy. However, there are some circumstances where the insured might want the insurer to waive its rights to subrogation. So in some relationships, the insured has, particularly contractors, they might have contracted to not permit subrogation against a principal. If the insured has contracted on this basis, they'll need to waive subrogation in their policy. So it's important for the insured to know if they need this. The insurer will then need to consider on what basis it might want to grant this. It might grant this on a blanket basis, so it might grant it wherever it's required by the insured, or it might want to restrict this to specific named contracts that the insured has told it about so that it can monitor where this waiver is needed. These agreements will need to then be reflected in the policy language. As a corollary to this, the insured also might want to grant indemnity to a principal, and this should be limited to where the principal sued for work that the insured has carried out, and that if the insured has been sued in their own name, they would have been covered by this policy. One case to consider where the waiver of subrogation has gone wrong or can go wrong is RFU and Conway. So this is a recent case where Conway thought that they were covered as co-insureds under the policy, and because of that they thought the waiver of subrogation would apply to them. However, the court held that they weren't co-insureds, and so the waiver didn't apply to them, as there was specific contractual language that the waiver only applied to co-insureds. And the insurer therefore could recover against them for work that was deficient. So it's always important to make sure you know if you're covered or not by the policy and what you're intending to be covered by. So to summarise this part, a few summary points. Indemnity will usually be the starting point for payments under an insurance policy. Variations from this will need to be expressed contractually and expressed clearly. It's important to consider how the limits will function in relation to what you're covering. If contracting out of the Insurance Act, it's important to remember to provide clear notice. If there is a danger of more than one policy being in place, then the parties should consider how these policies should behave in the event of a claim and put clear language in to achieve this. And finally, it's important to consider how the right to subrogate should be expressed and if it needs to be waived or preserved in a particular case. I'll now pass over to Michael to discuss dispute resolution. Thank you.
Thank you very much. Okay, I'm going to talk about dispute resolution clauses. First of all, I'm going to have a look at choice of law and jurisdiction clauses. Choice of law clause identifies the law of the country which the parties have agreed will govern the interpretation of the insurance contract, while the jurisdiction clause identifies the country or the states whose courts the parties have agreed will hear any disputes relating to the insurance contract. And it's important not to conflate the two. Now, frequently, these clauses are not given a great deal of attention during negotiations when underwriters are focused upon placing cover, earning premium, and everyone is best friends, and the general feeling is that we're never ever going to fall out with each other. But as and when a coverage dispute blows up, they become just about the two most important terms in the contract. There's a choice of law clause because it determines whether the policy covers what you think it covers, and the jurisdiction clause because it gets to identify who decides what it actually covers. So they are going to be key to how any dispute is going to play out. And the time to think about them and make sure that they're appropriate to the policy and that you're comfortable with them and their effect is when the contract's being written. Absolutely not when the first coverage dispute arises. Okay, looking at choice of law clauses first, there's an example of a clause on this slide. As you can see, it's neat and self-contained. It may be found in the policy schedule or in the wording. As to why it's important, well, it's important because, as I'm sure you're all aware, not all countries' laws are the same. And while we may have a very good idea how particular clauses and contracts will be interpreted under English law, it's not safe to assume that those terms will be interpreted in the same way by the law of another jurisdiction. The outcome can be very different, and terms, contract terms, conditions, exclusions, which we may be very familiar with under the law of England and Wales, can be regarded as objectionable and liable to being disapplied under the laws of other jurisdictions, and that raises the risk that the cover you think that you have written can change shape quite dramatically, and obviously having a significant impact on the outcome of any particular dispute. Now, ideally, the contract would be governed by the law of England and Wales, and this is because, well, by virtue of the fact that we, along with the Dutch, essentially invented insurance. In consequence, we have a very sophisticated body of insurance law, which has developed over the past 400 years or so. We've got a reasonable prospect of understanding how the contract will be interpreted under the law of England and Wales, and how it will respond to any given set of facts. The same is true of other common law countries, Australia, Canada, Hong Kong, and American states, for the same reasons, because they have bodies of law which have developed over a long period of time, and they're reasonably predictable. And that's simply not the case with countries with less well-developed systems of commercial law. What happens if you don't choose a choice of law? A governing law will be imposed upon you by whichever country's court hears the dispute, and so it's a hostage to fortune, and at the very least, you are going to be exposed to an additional layer of cost and uncertainty in addition to the underlying dispute. Turning to jurisdiction clauses. These clauses govern the country whose courts will hear the dispute. Normally, but not necessarily, this will be the same as the governing law. And there's an example of jurisdiction clause on the slide. Now, I'd invite you to look at the words exclusive jurisdiction in that clause. And this is really important because including the word exclusive, it guards against any argument that another competing jurisdiction's court might also have the right to determine any dispute. The clause can be found in the policy schedule or wording, as with the choice of law clause. Again, the choice of jurisdiction is important because not all countries' courts are equal. and the administration of justice can vary dramatically from one country to another. Some countries' courts are simply not used to hearing complex insurance or commercial disputes. Others overtly favour home parties or policyholders generally. And still others are unfortunately susceptible to political interference. So deciding which country's courts have jurisdiction over the dispute is going to be hugely consequential in terms of how the dispute will be determined. In favour of England and Wales, well, the commercial court is staffed by specialist judges who have a great deal of experience and expertise of dealing with insurance law and commercial disputes. We've got a long tradition in this country of the separation of the judiciary from the government and the impartial administration of justice. And you can be reasonably sure that you will receive a fair trial. And this is really why a huge number of commercial disputes end up in the commercial court in London. It's because parties, international parties, actively choose to refer their disputes here by including an English jurisdiction clause. In America, much the same can be said of the courts in the state of New York and other states like Florida and New Jersey. Other states in the US, however, have earned a reputation for being very favorable to policyholders. Texas, California, Massachusetts, to pluck some names out of the air. And if you find yourself before a court in those jurisdictions, then the dice are very much loaded against you from the start. Other things to bear in mind: in the US, you'll be exposed to trials by jury, which is an inherently less predictable way of determining a coverage dispute. You'll also be exposed to the concepts of bad faith and the potential award of punitive damages, simply for raising coverage arguments which would be regarded as perfectly respectable in this country. So the risk of unpleasant consequences for insurers in the US is much higher. You may find yourself writing a risk in a jurisdiction whose regulations oblige you to accept the jurisdiction of that country's courts, and in that situation, it's very much a case of weighing up the risks. Whether you're prepared to expose yourself to handing any dispute over to that country's courts, or if that isn't an unattractive proposition and you still want to write cover in that country, then you need to find an alternative to litigation, and that normally means arbitration. Now, an agreement to arbitrate takes the parties' dispute outside of the courtroom. The agreement's contained in an arbitration clause, which is normally found in the policy wording. And on the slide, there is a simple arbitration clause, but although it's very short, it contains the key elements. It identifies the seat of the arbitration, in this case, London. It identifies the institution whose rules will govern the arbitration process, in this case the LCIA, which is the London Court of International Arbitration, and it deals with the appointment of arbitrators. Typically, each party will get to appoint its own arbitrator, and then those two arbitrators between themselves will appoint an independent third arbitrator as an umpire. And the aim is to appoint arbitrators with expertise that's specific to the subject matter of the dispute. The policy will or should still have a jurisdiction clause, but the power that confers upon the court it identifies will be limited to dealing with matters which aren't within the scope of the arbitration clause. So any kind of interlocutory application, stays of proceedings to allow the arbitration to proceed, freezing orders or orders for enforcement of arbitration decisions at the end of the process. So very quickly some key features of the arbitration. Well, it's confidential, so there's no publicity, and in theory, the only parties who will ever know the details of the arbitration decision are the parties to the arbitration itself. It's flexible. The parties can agree on which procedural rules will apply, and they can tailor the procedure to suit the subject matter of the dispute. So if a particularly efficient or speedy determination is required, then there is scope to make that happen. Finality, like a court decision, the decision of an arbitration tribunal is binding on the parties. But unlike a court decision, there is very limited scope to appeal from the decision. So is usually the end of the story. And finally, neutrality. Arbitration allows the parties to avoid litigating in a hostile jurisdiction. And it's a way of significantly mitigating the risk of being exposed to a courts in a jurisdiction which you just don't trust to be able to administer justice fairly. Turning to another alternative dispute resolution mechanism, mediation is essentially involves without prejudice settlement discussions before an independent mediator, and their role is to try and facilitate a dispute, so a resolution of a dispute between the parties. Its key features is a confidential process, and all the discussions are without prejudice. So nothing that is said at the mediation can subsequently be held against a party. It's a consensual process, so the mediator doesn't have the power to impose a settlement on the parties. The parties have to reach a point where they can agree terms, and if they can't do that, then they walk away and they get on with the litigation or arbitration. Why would you want to mediate? Well, ultimately, no one really wants to litigate to trial or go through arbitration to a final decision if they can possibly avoid it. And settlement by mediation allows the parties to agree an acceptable outcome without all the cost, time, and uncertainty of court or arbitration proceedings. So you can negotiate an outcome that both parties can live with, rather than having one imposed upon you by the court or the arbitration tribunal. It's extremely effective. Over 70% of mediations result in settlement on the day, and a further 20% settle shortly thereafter before trial. So it does work. And finally, the courts are very keen on it. The commercial court will encourage the parties to mediate at various specific points in the course of litigation. It's got the power to stay those proceedings to make space for a mediation to take place. And if ultimately it forms the view that a party has unreasonably failed to engage in mediation, it's got the power to impose some quite unpleasant consequences upon that party. So that's all I have to say about dispute resolution, other than to give you an example of what happens in a situation where jurisdiction clauses are not properly drafted. And this is a case which was recently before the commercial court, Access against ABSA, and it involved a coverage dispute which had developed between Access, which underwrote a liability reinsurance program which reinsured ABSA, the large South African banking group, and ABSA made a huge claim on this reinsurance program, which went well into the excess layers. ABSA initiated declarative judgment proceedings in South Africa, and Access in turn sought a stay of proceedings in the commercial court, arguing that the parties had agreed that the courts of England and Wales should have exclusive jurisdiction over all disputes. Now, I would invite you to have a look at the first jurisdiction clause, that's in the primary layer clause, and see what it says. because it purports to give jurisdiction to the worldwide court, and it says that the parties have agreed to submit to a worldwide jurisdiction. Now, there is no worldwide court, so that bit's meaningless, and submission to a worldwide jurisdiction means you're willing to let any court in the world determine the dispute. So, it might as well not be there. The second jurisdiction clause in the excess layer is a better effort, although it confers jurisdiction on the courts of England and Wales, although it fails to state that jurisdiction should be exclusive. So it more or less gets it right, but not quite. So at first instance, the commercial court granted an interim stay of proceedings in favour of Axis. So stayed the South African litigation, and the judge commented with a certain amount of understatement that these clauses were quotes somewhat poorly worded, close quotes. I think he was being extremely polite. So then the claim then, several months later, returned to the commercial court for the substantive hearing to decide whether the stay should remain in place indefinitely, so that the dispute could be heard in its entirety by the commercial court. So I would invite you to consider whether the commercial court decided that it had jurisdiction over the dispute, whether that was or whether that was limited in any way to the primary or the excess layers of cover. Well, the answer is that the court decided that it did not have power to continue the stay in respect of the primary policy, because try as it might, it couldn't hold that the jurisdiction clause in that policy gave exclusive jurisdiction to the courts of England and Wales. There was simply no legal basis to imply that it did in the absence of express words to that effect. It was, however, prepared to continue the stay in respect of the claim on the excess layer policies. Because it said that it was reasonably clear that the intention of the parties was that the courts of England and Wales should have exclusive jurisdiction over those disputes under those policies. So the outcome is that you had two parallel sets of proceedings on different layers of the reinsurance program in different continents going on at the same time, with all of the cost, aggravation, confusion that involved. And that's an object lesson in where parties can find themselves if they don't pay attention to the jurisdiction clauses when the policy is being written. So just to summarize, what I would like you to take away in relation to dispute resolution clauses, I think it's really short. Just for every wording that crosses your desk, does it have a choice of law clause? Does it have a jurisdiction clause? And are you comfortable with what they say? And if you get those right, then if you do find yourself involved in a coverage dispute, at least you know, or you have an idea how it's going to be dealt with and how it's going to play out. Okay, thank you very much for that. I will now hand you back to Tom.
Excellent. Thank you very much, Mike. Just a brief close from my perspective to thank you very much for taking the time to watch this session. We really hope that you enjoyed it and found it valuable. There's certainly a lot of ground covered. We'd also encourage you to keep an eye out for sessions 3 and 4 in this series. They'll be dealing with London market processes and reinsurance structures, respectively. Now, from our perspective, we'd certainly encourage you to get involved in the policy wordings process if you can. Certainly speak to colleagues, ask any questions of them that you have, both on the underwriting claims and the technical wording side of things. And you'll see the big message that tends to come through from these sessions is make sure that you're reading wordings in details when you do get it in detail, when you get involved in the process. and certainly to not be afraid of asking questions. If you do have any questions for us, so for any of the speakers here, or perhaps for me regarding the IUA's Clauses Committee, please feel free to reach out. We're always very happy to receive those inquiries. And then the final thanks from my perspective will go to our 4 speakers who, of course, gave up their time for this session. So thank you, Natasha, Chris, Mike and Rachel. I really enjoyed making this one available. And hopefully we'll see everyone at the next session 3, that will be coming in Q3 of this year. And we'll leave it there. Thank you very much.